In this example, we are going to be looking at the average cost method under the perpetual inventory system. So you want to keep in mind the differences that you learned between the periodic and the perpetual systems back in Chapter 6. The biggest difference under the perpetual inventory system is that after every time we sell inventory, the inventory account and the cost of goods sold account is updated immediately. So what that means here now is that we can't wait until the end of a period to update our cost of goods sold account, and the days that the sales are made are actually important because we can only sell what we actually have. So here in front of you we have all the information for our vegan company, and then on the right hand side you see the date that we made the sales and the units that were sold. So beginning with the average method, the first thing we're going to do is we're going to write down our beginning inventory. So we have 40 units that cost us $10 a piece for a total of $400. Then we made a purchase of 50 units at $11 a piece for $550. And if you notice in the dates up here in the top, the next date that something occurred is a sale on August 15th. So before we can calculate the sale, we have to calculate our average cost, which we're going to call our balance. So to calculate our balance, we have to use the equation cost of goods available for sale divided by units available for sale. So at this point in time, all we have is our beginning inventory and our purchase. So we take our $950 for our total of those divided by the 90 units, and we get $10.50 as our 56 cents as our average cost. And that kind of makes sense because we had 40 units at $10 and 50 units at $11, so it's going to be somewhere in between $10 and $11. So then we're ready to record our sale. So we sold 45 units times the average cost we just calculated of $10.56 for a total cost of $475. Now what we just calculated there was our cost of goods sold. That $475 is part of our cost of goods sold. So we're also doing it a little bit differently. We're actually calculating the cost of goods sold rather than finding our ending inventory and subtracting like we did in the periodic method. So the next date we have is August 22nd. So we're going to calculate our balance. What do we have left? We have 45 units left at a cost of $10.56. So now we're ready to add our purchase from the 22nd. We bought 35 more units at $12 a piece. You'll notice our costs are rising. So that was a total of $420. And then our next date up here is the 28th. So before we can calculate our sale, we're going to calculate our balance. What do we have left? And we're going to have a new average cost because of this $12 going to factor in there, so it's going to change our average cost. So now we have 80 units for a total cost of $895 because we summed these two together. So $895 divided by 80 units gives me a new average cost of $11.19. And again, that increased because of our purchase that were $12 a piece. So then we're going to sell 25 more, and they're going to sell them at our cost is $11.19. So another cost of goods sold is $280. And then after the 28th, we're ready to calculate our ending inventory. We have 55 units left in our ending inventory. We had 125 available. We sold 45 and we sold 25, so that gives us 55 left in our ending inventory at our last calculated average cost of $11.19. Gives us an ending inventory of $615. So then to calculate the cost of goods sold, we sum up the 475 from this cell and the 280 from this cell. And if you wanted to put it in the format that we've used, you can. Cost of goods available for sale, $13.75, less ending inventory of $615 gives us our cost of goods sold of $755.